Welcome to Fairport Flash, the monthly economic update powered by the Fairport investment team. Our team gathers the most recent news, data, and research and distills it into the information most important to you. Let's get started.
Welcome to this late summer edition of Fairport Flash. My name is Rick D'Amico, Manager of Investments at Fairport Wealth. I hope everyone is doing well. As part of the investment team at Fairport, I'm primarily responsible for overseeing the firm's fixed income and liquid alternative investment strategies. So let's get started. Today I'd like to discuss the current low yield environment, which has led to several questions from both our clients and their advisors. Let's start by discussing Fed funds rate expectations, which are essentially pegged at zero for the foreseeable future, and that's according to both the FOMC year-end estimates as well as market expectations. As such, the front end of the yield curve remains anchored at 0.15% or lower going out to 3 years and doesn't offer much pickup in yield thereafter, but it begins to steepen slightly from 5 to 10 years, with 10-year treasuries yielding 0.72%. What investors should be cognizant of is the real rate of return for fixed income investments, or the return after accounting for inflation. While it is true that we are in a low inflation environment, as of August 31st, 2020, 10-year Treasury yields still offered a negative real rate of return of minus 0.85%, meaning investors that purchase these securities are essentially locking in an erosion in their purchasing power. And while inflation may not be a concern in the near future, at the most recent Fed presentation, Chairman Powell discussed a willingness to let inflation run above target, further impacting purchasing power if yields remain at current levels. Last Thursday, the Fed announced this important change to its monetary policy strategy, which now states that they will be targeting an inflation rate that averages 2% over time, leading investors to anticipate that the Fed may let inflation run higher for longer than expected. The current low yield environment is having a large impact on both fixed income and cash returns, and the low rate environment is something investors are dealing with on a global basis, not just here in the United States, as almost 80% of developed market government bonds are yielding less than 1%, with about one-third offering a negative yield. So in absolute terms, interest rates remain stubbornly low, but in addition, credit spreads have now also rallied below their historical averages across most sectors, leading to richer valuations. Investment-grade corporates, high-yield bonds, U.S. agency spreads are all well below their historical average. High-yield bond spreads were as high as 1,087 basis points at the peak of the crisis on March 23rd, but have since rallied sharply all the way down to 490 basis points, helped by support from the Fed. That's not to say that if the economy continues to improve that credit spreads could not grind tighter towards their previous lows, but from a valuation perspective, investment-grade and high-yield corporates appear slightly rich, and there is still a lot of uncertainty regarding issuers in the retail, restaurant, and energy sectors as we continue to sort out the longer-term ramifications of COVID-19. In addition, the duration of the investment-grade sector has continued to lengthen and as of the end of August at 8.7 stands at its highest level in the past 30 years, exposing investors to more sensitivity in interest rate movements. Factor in that the current 30-day SEC yield on the Barclays U.S. Aggregate Bond Index is just 1.2%, and you have the unfavorable combination of extremely low yields with higher durations. So as far as fixed income returns are concerned, we are very cautious given the low level and starting yields, the increased duration in the credit markets, which exposes investors to higher levels of interest rate risk, as well as valuations within credit that are slightly rich compared to historical averages. Our focus within our portfolios has been on adding duration only when we are being adequately compensated, as well as moving up in credit quality given current spread valuations and uncertainty surrounding some of the more credit-sensitive sectors of the market. So we've talked about our outlook for the fixed income markets, but the current low-rate environment is not doing savers any favors either. Savings and money market yields are back to historic lows, and in fact, most money market funds are once again in a position where they are waiving management fees just to keep 7-day yields positive. For example, the Schwab Value Advantage Fund is yielding just 0.03% with waivers, but without fee waivers, its yield would be a negative 0.17%. To further put this in perspective, according to this analysis by JP Morgan, the income generated over 12 months in a $100,000 savings account is a paltry $240, well below the $1,566 level needed to keep pace with inflation, and falling remarkably short of the levels needed to keep pace with educational and medical care inflation. We understand this is a concern for both our clients and advisors, and we are constantly analyzing other cash solutions. But it is important to remain cognizant of the fact that it is very difficult in this environment to meaningfully increase yield on cash without taking on either significantly more credit risk or duration risk. And in our view, this is not the time to reach for yield. So where are investors going to put money to work in this environment? I'm sure many have heard the acronym TINA, which stands for There Is No Other Alternative. And this is in reference to one of the supports for the stock market going forward. This essentially means that with cash yields and fixed income expectations so low that investors have no other alternative other than stocks to earn a meaningful return. This is further illustrated by the fact that the percentage of S&P 500 stocks with dividend yields greater than the 10-year U.S. Treasury yield is at 68.59%, near its highest level in the past 50 years and over 3 standard deviations above its mean. While this could be a support for the stock market going forward, I would recommend discussing your current allocation with your advisor, as increasing your equity allocation will also increase the risk within your portfolio. Within fixed income, especially for individuals in the upper tax brackets, municipal bonds could also be a consideration. Municipal bonds are yielding more than U.S. Treasuries across the curve, even on a pre-tax basis. However, the front end of the curve is still very flat at low yield levels until you go out 5 to 30 years in duration, and 30-year AAA municipal bonds are still yielding just 1.6%. So what can we expect from municipal bond investors going forward? Eaton Vance put together a scenario analysis which provides a good summary of what we could expect in the municipal bond market as we head into the next 12 months. Using the intermediate term municipal bond index, if U.S. Treasury yields remain at their current level of 0.72%, municipal bonds would likely return 2.35% over the next 12 months. If yields increase to 1.15%, the expected return on the municipal bond portfolio would fall to 1.15% over the next 12 months. And if yields were to fall approximately 40 basis points to 0.35%, the municipal bond portfolio would return 3.45%. I thought this was a good analysis showing a range of different outcomes and what we could expect in the fixed income markets over the next 12 months. So while our expectations for fixed income returns are muted and cash yields remain remarkably low, I think it is important to focus on the main role of fixed income and cash from a portfolio perspective, and that's for stability, diversification, and reducing risk in portfolios. And in our view, now is not the time to reach for yield or over-allocate to higher-risk sectors of the fixed income markets, as doing so could bring added volatility to your portfolio at a time when you are most relying on it to bring diversification and stability. This brings us to the close of today's Fairport Flash. As a reminder, our goal at Fairport is inspiring families, and as a member of the investment team, we strive to do this through a long-term and diversified approach. If you would like to discuss any of today's general topics in more detail, please reach out to your Fairport team. Thank you for listening, and look for the next Fairport Flash in about a month.
Fairport is a group of investment professionals registered with Hightower Securities, LLC, a member of FINRA and SIPC, and with Hightower Advisors, LLC, a registered investment advisor with the SEC. Securities are offered through Hightower Securities, LLC. Advisory services are offered through Hightower Advisors, LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is not indicative of current or future performance and is not a guarantee. The investment opportunities referenced herein may not be suitable for all investors. All data and information referenced herein are from sources believed to be reliable. Any opinion, news, research, analysis, prices, or other information contained in the research is provided as a general market commentary. It does not constitute as investment advice. Fairport and Hightower shall not be in any way liable for claims that make no express or implied representations or warranties as to the accuracy or completeness of the data and other information, or for statements and errors contained in or omissions from the obtained data and information referenced herein. The data and information are provided as of the date referenced. Such data and information are subject to change without notice. This document was created for informational purposes only. The opinions expressed expressed are solely those of Fairport and do not represent those of Hightower Advisors LLC or any of its affiliates.